Welcome to Financial and Investment Wisdom. The Great Recession, which affected many people's lives, ended in 2009. It's a good idea to assess how to benefit from the recession rather than letting it harm you, now that the economy seems to be headed for another dip. For investors, many of whom saw their investment accounts destroyed by selling in the panic, there were many lessons to be learned. Any recession begins with learning this lesson. A recovery that features a robust stock market bounce always comes after a recession. You can take advantage of the recession while the whole world is going into a panic. In all honesty, it is the best time to invest and make a good fortune. So let me tell you 3 ways you can take advantage of the recession. 1. When share prices decline, use the dollar cost average. You won't likely predict the next recession, as is the case with the majority of them. However, a stock market sell-off will probably occur far before a recession. When that occurs, keep in mind the first lesson: a recession is followed by a recovery. Knowing this, investors can use the dollar cost averaging approach of investing to profit from a decreasing market. You already employ this strategy if you make regular monthly contributions to a qualified retirement plan. The time to start dollar cost averaging in a non-qualified investment account or increase your contributions is when the market begins to decline, though. By dollar cost averaging your investments, you steadily lower your overall cost basis in the share price, ensuring that your cost basis is always less than the price when the price of the security recovers. For instance, if you contribute $500 per month to a mutual fund selling 20 shares for $25, 20 shares are purchased. Your donation will purchase 25 shares if the share price falls to $20. There are currently 45 shares in your account with a $22 average cost basis. Your $500 payment will buy more shares when the share price declines, lowering your cost basis as a result. Even if your monthly contribution purchases fewer shares as the market recovers, the current share price is always greater than your cost basis. 2. Buy into dividends. The greatest equities to own during a recession are those from well-established, large-cap corporations with solid balance sheets and cash flows. These businesses not only have a higher chance of surviving economic downturns than smaller ones with weak cash flows, but they are also more likely to distribute dividends. Dividends have several uses for investors. First, you may rest easy knowing that a company is financially stable and can endure most economic circumstances if it has a lengthy history of paying and raising dividends. Second, dividends act as a cushion for returns. You still earn a return on your investment even when share prices fall. These factors explain why dividend equities typically perform better during market downturns than non-dividend stocks. Investing exclusively in dividend-paying firms through mutual funds or exchange-traded funds is the best option to buy dividend equities. High current yields and capital appreciation are typically produced by funds that invest in businesses with a long history of paying dividends and a solid track record of raising those payouts. However, don't anticipate these funds to do better than the market when the market recovers. They are kept in portfolios to offer consistent returns over several market cycles. You can gradually move money out of your dividend funds when the market recovers, but you should always keep some as a safety measure. 3. Invest in everyday necessities. Consumers still need to purchase food, medications, personal care items, and medical supplies during economic downturns. These are the final things to be trimmed from the household budget because they are basic necessities. Therefore, businesses providing food and other fundamental requirements do not experience revenue declines, whereas businesses selling flat-screen TVs and other discretionary goods do. Because of their propensity to hold their ground even when the economy is struggling, consumer goods businesses are occasionally referred to as defensive stocks. According to data, these companies performed better over the previous 5 recessions. Walmart, Conagra, Johnson & Johnson, and Procter & Gamble are examples of firms that make consumer goods. These specific businesses also have strong dividend payouts, which heightens their defensive profile. Additionally, there are mutual funds that only invest in businesses that produce consumer goods. By keeping these in mind, you can avoid being in a disadvantageous position during the recession. If you enjoyed the video, Give it a thumbs up and don't forget to subscribe to the channel.